Welcome, ladies and gentlemen, to Real Estate Roundup. I'm Emmanuel Romanis. As always, if you want to contact the show, simply send us an email at realestateroundup@outlook.com. We have a great show lined up for you today. Joining me a little bit later in the program is going to be Jim Campitas. He is an investment advisor with Merrill Lynch, and we're going to talk specifically about how real estate fits into a typical investment portfolio. So stick around for that. He'll be joining us in a little bit. I want to start off the program by talking briefly about your senior years. I do a lot of work with retirees, and they definitely face some different scenarios than other people do, just as newlyweds face different scenarios in midlife, children, things of that nature. Seniors kind of have their own little mix of scenarios that they have to face. And downsizing is one of the biggies that seniors face. So, there are four areas that I want to point out that can make it a little bit easier if you are one of those people who are facing to downsize. And one of them is, in general, you want to get a handle on your belongings when you're downsizing. So the first thing is items the family and friends adore. And, the heirloom that Cousin Jesse has wanted for the last 15 years, things of that nature. It's time to let those things go. Turn them over as gifts of joy to your heirs, to your loved ones, to family and friends. Because what will happen is they will cherish them as much as you do, and they will become lifelong keepsakes. So let them go. Let other people enjoy them as you have over the years. Number two is your truly valuable items. Get a professional appraisal. Find out what these things are worth. Is it something that you want to keep? Is it something that you want to sell? An easy way is to go on eBay and find out what exact items are selling for. Not what like items have sold for, but the exact items. So if you have a Woodmere China place setting, then you want to see on eBay what Woodmere China place settings have sold for. Not what the asking price is, but what they're actually selling for. That's a real quick, easy guide as to what something you have may be worth. Private effects, old magazine issues, lists of coulda, woulda, shouldas over the years, excess paperwork. Get rid of it. It's time to throw that stuff away. You haven't done anything with it in the last 25 years. Highly doubtful you're going to do anything with it now. And times have changed so much. Is it really relevant right now? Toss it. Children's memory box, the final item. Trophies, awards, Little League, report cards. Give it to the children if they want it. If not, toss it. What are you going to do with it? The memory is still up here. But right now, honestly, it's just stuff that's cluttering up. And if you're downsizing, you don't need to clutter anymore. So just some basic things to look at if you're going to downsize. Now, with that, we come to our segment, Who Knew? Now, last month, as many of you know, we in our fair city of Pittsburgh hosted the U.S. Open golf tournament. So this is going to be a golf Who Knew. Pebble Beach, Torrey Pines, storied golf courses that offer breathtaking views of the Pacific Ocean. Augusta National, it is known as the house that Bobby built, Bobby Jones, the great golfer. And humble little Oakmont Golf Course in western Pennsylvania. How does our little humble golf course at Oakmont eclipse the great rivals? The answer when we come back.
Visit the Oliver Miller Homestead, an 18th century reenactment site located just off the circle on Corrigan Drive in South Park. Self-guided tours are available each Sunday from May 1st until December 8th from 1:30 until 4:30 p.m. with guides in 18th century garb located around the grounds to answer questions and to give information. Your tour will begin in a reproduction bank barn where displays give information on the movement west. You will also see the Miller Still and learn about the production of whiskey and the importance of it and of the Whiskey Rebellion to this area. Follow the Miller Trail up the path and visit the transportation shed, demonstration shed, forge, a reproduction log house, the original spring house, gardens, and finally end at the stone house. Each month, the guides host at least one special event. The homestead is also a great place for tours, tailored to the needs of school-aged children, scout groups, or adults. Visit our website at www.olivermillerhomestead.org for a schedule for the year and much more information on the history of the Miller family, our organization, and pricing information.
Welcome back. Well, as many of you know, last month we in our fair city of Pittsburgh hosted the U.S. Open golf tournament. Now, surprisingly, at least it was surprising to me, is the Oakmont Country Club has hosted more combined USGA and PGA championships than any other course in the United States, including 8 U.S. Opens, 5 U.S. Amateurs, 3 PGA Championships, and 2 U.S. Women's Opens. It is currently ranked number 5 in the most recent version of Golf Digest Top 100 Courses in America. Who knew? Now, joining me is Jim Campitas of Merrill Lynch. Jim, welcome to the program.
Thanks for having me, Emmanuel.
Oh, pleasure, pleasure. And I know you deal mainly with all type of investments, large, small, the retiree, the young couple, seasoned veterans. You handle it all, which is one of the nice things of why I wanted you here. But specifically, I kind of want to talk about how real estate fits into an investment portfolio, whether it's a young couple just starting out to grow their nest egg. Maybe we're talking about a retiree who's looking to start utilizing what they've accumulated over the many years. It could be in a professional investor who flips properties or maybe is involved in commercial properties, real estate trusts, whatever the case may be. But on a general level, Jim, general home ownership. Let's start there. Let's start with something very basic because my guess is that for most people, now this may not be most people that you deal with, but for the vast majority of Americans, a home is probably their largest single investment in their lifetime. Correct?
That's correct, yeah.
Okay. So as far as the average homeowner, myself, this is my house is my biggest investment. What could I expect over the years as far as utilizing that as part of my retirement?
Sure. So it's interesting, Emmanuel. One of the funny things is that today the average investor will hold on to his home for about over 10 years, maybe up to 30 years.
Okay.
But what happens is a general stock or a bond, they'll only keep for about a year or so. So there's a psychological difference there, first of all. Second is, now depending on what you're using the real estate investment for, whether it's cash flow, diversification within a portfolio, there's some different ways that you would want to use it.
Now, when you say a stock or bond, you're talking about institutions that may buy up tracts of real estate or large portfolios of real estate as an investment, correct?
Right. So
Okay.
so you're referring to a real estate investment trust, which we call a REIT.
Okay.
And what happens in a REIT, and they basically work like a mutual fund. You'll have the team of portfolio managers will go out and buy, whether it's actually the properties themselves, construction loans, or mortgages. And what the investor will see is actually the cash flow from those rents or from the different ways that they're using the money.
Okay. Okay. Now, as far as, let's say I'm one of those people that holds my home for 30, 40, maybe even 50 years. I'm now in my retirement age, golden years. Can't see, can't walk, but it's my golden years. So now I'm starting to use my pension. Maybe I'm at the point where I'm getting Social Security. I'm looking at some type of cash flow problem. But I have all this equity built up in my home. Now, I see all kind of advertisements by big TV stars, some has-been stars for these reverse mortgages.
Okay.
My understanding at a very basic level, Jim, is the reverse mortgage will let me unlock some of the equity in my home. That way I can use as physical cash today. Is that basically what a reverse mortgage does?
It is, and they're very similar to your home equity line of credit, where
Okay.
you're utilizing the equity within the home, but the caveat with the reverse mortgage is you don't have to pay it back
Okay.
until one of two things happen. You sell the home,
Right.
or you pass away.
Okay.
Now, once you pass away, your heirs have a choice. They can either sell the home or they can pay the mortgage off and keep the home if they
Okay.
choose.
So the bank or the institution that's underwriting the reverse mortgage, they're going to get their money at some point. They just get it on the back end.
Right, and you're also on the hook in a reverse mortgage for the interest and the taxes, your income taxes,
Okay.
and the insurance. So the homeowner or the borrower still has to pay those costs.
Okay.
So what the bank will do is actually, and this is new as of 2013, is they'll run a small credit check. Prior to 2013, no checks at all.
Okay.
Much easier to get a reverse mortgage. They tightened up the limits a little bit, and now they do a small credit check just to make sure that you have the cash flow to pay for the taxes and the insurance costs.
Now, on a reverse mortgage, Jim, do me as the homeowner, do I maintain the ownership of the home, or does the institution take over ownership?
You do maintain ownership. Your name stays on the title.
Okay.
What happens though is the bank the bank can take over the home. There's no foreclosure per se.
Okay.
But what can happen is if you default on the cost of the taxes or the insurance, then the bank can go ahead and sell the home. Now, in the origination cost for the reverse mortgage a little bit higher.
Okay.
There are some payments up front that, depending on how and when you pull the money out and how
Right.
quickly, there's some additional charges. So you have to be careful with the reverse mortgage. They
Okay.
can get pricey.
Okay.
So do your homework.
Okay. So in essence, the bank or whatever institution is underwriting the reverse mortgage, they have a lien on your home.
Right.
Okay.
Which, and good point, you can't have any liens on your home going into it. And any liens or any mortgage balances on the home need to be paid off with the cash you get from the reverse mortgage.
Okay, so you in order to qualify, one of the caveats is you have to own the home outright, free and clear,
More or less.
no liens.
Right.
Got it. Okay, so even say, if I took out a line of credit 10 years ago and I have a $3,000 balance, I would need to pay that off before I could apply for a reverse mortgage?
Right.
Okay, got
And
it.
there's a couple of different ways they'll give you the money. I mean, you
Right.
have an option for payments over time. You can get it lump sum or a combination of. So using those different combinations, if you have a balance on the mortgage, you can pay it off and then continue to get your periodic payments.
So it's kind of like winning the lottery. I could take a lump sum or an annuity payment.
Or a combination of both, right?
Hey, I won the lottery. Good for me. All right. Now, this is probably something that you deal with more often, and it's obviously a little more complex. So, let's get into it a little bit. Investment property, residential, commercial. What do you see out there as far as what's hot right now? What is kind of falling out of favor? What's the market doing with regard to investment properties?
Well, the interesting thing is now with interest rates. I mean, interest rates are at all-time lows, so traditionally people were buying bonds and just picking up the coupon payments on their bonds, 6, 7, 8%,
right,
and getting the income that they needed in retirement. Now that's not the case. So people are starting to spread into some riskier assets, whether those are stocks, bigger companies, or real estate. And real estate is an attractive investment because of the cash flow.
Okay. What about tax advantages? Does real estate as an investment offer different tax advantages than, say, holding personal property, a stock, a bond, something like that?
Well, I mean, if you own the piece of property, you can take some write-offs on your tax return.
Okay.
The cash flows, however, any rents that you're getting, those are taxed on your income tax rate, so you have to be careful.
So rents would be considered taxed as regular income?
Right.
Okay. And I know a lot of times you hear with property capital gains tax. Now, what exactly does that entail as far as what is a capital gain and how is that taxed as opposed to, say, regular income?
Right. So capital gain is actually what you've made, over and above what you've paid for on the property.
Okay.
So very simply, if you bought your home, let's say, for $50,000
right,
10 years ago, 20 years from now, you're going to go and sell the home for $400,000.
Okay.
You have a nice $350,000 gain.
So the difference between what I purchased it for and what I sold it for is considered my capital gain.
Right, but you mentioned tax advantage, and here's one of the advantages in real estate is when you go to sell, as a single owner, you have a $250,000 exemption. As a joint owner with you and your wife, you have a $500,000 exemption. Now, what does that mean? Let's use this.
I'm glad you said that because I was going to ask you. That sounds good. What does it mean?
Sure. So let's go back to our example.
Okay.
You bought your home for $50,000,
right,
and you're going to sell it for $400,000.
Okay.
You've effectively made $350,000 on your home.
Right.
Well, that's a lot of money to pay taxes on.
Right.
The $250,000 exemption as a single taxpayer takes $250,000 off the top. So instead of paying the $350,000, you're down to only having to pay $100,000 in capital gains.
Oh, okay. Okay. So it's as if that first $250,000
disappears.
Okay.
Right. Yeah.
Okay. Okay. And you say for a married couple, it's double that, $500,000.
Right. So you could essentially get away without paying any capital gains tax.
Now, is that for your personal residence, or is that for a piece of investment property?
That's your primary residence only.
Primary residence.
Primary residence is defined as having lived in the property or your home for 2 out of the previous 5 years.
Okay, so if I have a vacation home in Arizona and I sell that, I stay there maybe 3 times a year. That doesn't apply to that property.
Right, but what does apply is if you take your money and go ahead and buy another piece of real estate, you can transfer effectively those monies. So any money that's put into the new home will net itself out and not have to pay capital gains on.
Now that's for my investment property.
That's for your
That's for my
property.
vacation home.
Right.
Okay, so I just want to make sure I get it straight because sometimes it gets confusing. My vacation home in Arizona. All right, I go to sell that, and then I turn around within a month, or whatever the time period is. I turn around and I buy another piece of investment property. I can avoid capital gains tax, or at least maybe a portion of it,
right,
because I've turned it over and reinvested that money in real estate again.
So exactly.
Okay.
And a simpler example than we were using, let's say you bought your Arizona vacation home for $100,000.
Okay.
And you sold it for the $400,000.
Right.
You've made the $300,000, but if you go ahead and buy another $200,000 home somewhere else in Arizona, that'll net itself out and you're only paying the $100,000 capital gain.
Okay. Okay. So I'm getting the benefit as if it were my personal property, but it's just a different way of calculating it.
Right, and this is what makes it a little difficult for me to work with some real estate investors because they're essentially kind of their own breed. Because
Right.
once you start to get into real estate with those tax advantages, you kind of stay in real estate.
Okay.
Because when you try to unwind and get out, you end up having a pretty large capital gains tax to deal with.
Okay.
So a lot of those real estate investors just continue to recycle their money into.
And is that, I've heard bantied about a bit, Jim, in real estate investment fields, like-kind property. Is that what you're talking about here? Is it in other words, I can't sell my vacation home and go buy a yacht
Right.
and expect the same type of tax advantages. It needs to be like-kind investment property for investment property.
Exactly.
Okay.
And they're
okay.
it gets a little complicated into swapping properties.
Right.
It's, something called a 1035 exchange. I'm sorry, not a 1035 exchange. I don't remember the exact tax number on it, but you can swap properties with other individuals, and it starts to get a little complicated in there. But
Okay.
once you get into the real estate game, you tend to stay in that real estate game.
Here's the point. If you get into this game, make sure that you have not only a qualified investment advisor, but a qualified tax advisor as well, because it sounds like it could get kind of complicated, and it doesn't sound like something that you would want to go into on your own. So make sure that you have professional help to guide you through these different transactions. Make sense?
Exactly, Manuel. and it gets a little over my head. But where I tend to help is with these projections. So
Okay.
when you're looking at gains or different types of uses for your real estate, or if you're gonna, let's say you're gonna try to, the biggest question I get: should I pay off my mortgage
Right.
when I go into retirement, or should I let it go?
Okay.
And now with low interest rates, people are saying, well, should I keep it and I'll have some additional cash flow
Right.
if I don't have to take the big chunk out of the mortgage in retirement?
Okay.
So it's a loaded question, and there's no easy answer for it. So a lot of what we do is make projections, and it's called a Monte Carlo analysis,
Okay.
which will actually use historic returns from the stock market. But what we'll do is we'll project your cash flows into the future to see those different scenarios between selling the home, paying off the mortgage,
Okay.
having the additional cash flow, and show you those the different ways that it may be to your advantage to do one or the other.
Now that's called a Monte Carlo scenario. These projections.
Right.
Okay, so it's not tied into Vegas, right?
No.
All right. Okay. Good. That's interesting, and I could see where that would be very helpful to somebody because these are big questions, especially in retirement. You have, do we downsize? If I do and I sell my home, how am I going to get hit tax-wise? If I keep it, can I maintain the home? Maybe my health is failing, so I need to look at things like that. Maybe I want to give my heirs a leg up and let them use the money. I mean, these are a lot of questions that everyday people face all the time. So I could see where you and someone like you in your industry is very valuable to sit down and be able to project these things out. And it's like with anything else, Jim, I would imagine, information is key.
Right.
So before you make a decision, sit down with somebody who's qualified to give you the facts, give you your options, and then they can make a good decision.
And that's exactly it. People like to see what their options are.
Right.
And between what we do, your tax advisor, sometimes the attorney, getting these professional advisors together to give you your options really helps provide some peace of mind.
Okay, good deal. Well, I'll tell you what, this was a lot of good stuff. Some of it a little bit over my head, but that's okay. My viewers are a lot more savvy than I am, so that's good. Is there anything that you'd like to bring up or talk about that you think is relevant to the viewers that we haven't touched on?
Well, the one thing you mentioned was downsizing. That's another big question I get. And really, at the end of the day, downsizing is quite simple. We don't get too complicated with that. You're reducing some of those payments. Mm-hmm. In some cases, you can reduce or take out altogether the mortgage. The one thing you want to be careful of, though, and this is where you may have some information for us as a real estate agent, is the warrantability of condo mortgages. Now, I know that sounds confusing. But so what happens when you go into a condo, the first thing you want to look for, because a lot of downsizing happens into condos,
Sure.
condominiums and townhouses.
Sure.
Keep an eye out for those the homeowner association fees.
Right.
Know what you're paying for, know what you're not paying for.
Right.
Again, you want to see your options between the cash flow that you're outlaying now, any cash flow that you will be putting out, bills, that kind of thing.
Right.
But in a lot of cases, it's not always easy to get a mortgage for a condo. And
Yeah, I find that out.
right. And as a condo owner myself, I know that also.
Yeah. Well, I'll tell you what, that is good advice. And again, it circles back to the very general premise. Before you make any decision, get all your ducks in a row, get all the options, get all the information. That way you can make an informed decision.
Right. Ask a lot of questions.
Yeah, instead of just shooting off for the hip and saying, okay, I'll do this, and then you find out a year later, man, did I make a mistake.
Right. And you're entitled to all this information. Ask the bank questions, ask a lot of questions, and make sound decisions that way.
Fantastic. We'll be right back.
I brought out a show on the radio about 5 or 6 years ago to try to share a lot of the information that I run across on a weekly basis with clients, and to share those experiences and the knowledge gained from other people's either mistakes or the correct decisions they've made and their successes, and to try to share that with the community so more people could benefit. So we came over and met Dave, and it was real easy. He said, there you go, are you ready? We're very lucky to have this and the resources over here, where it would be quite expensive to try to produce a show like this elsewhere. Bethel Park TV is offering it to all of us. I hope this grows a lot, and I hope a lot more people do take advantage of this. You're missing out on a marvelous opportunity if you don't. It's really a free gift for you to be able to share yourself and your experiences and what your value is with others at low to no risk. Anyone who's considering doing a show, come on out of your shell. Come on over here. Dave's very gentle, very nice. He'll help guide you through this. If you make mistakes, he'll edit it out and record it over, so don't worry about saying something wrong. Just come over and share what you have with others. Just be yourself, come over here and let other people see who you are, why you're here, and who you're trying to help and what you're trying to say. It is that easy.
Welcome back, folks. Well, I hope you find what Jim Campitas had to say interesting. I find it very interesting. Learned a couple things. Some of it I knew, some of it I didn't. Some of it went over my head. But as I said, you are more savvy than I am, so hopefully that you caught everything. I want to jump into the mailbag real fast. We have a little bit of time. I got this from Pete, who lives in Bridgeville, and he asks, what is a ground lease? Well, a ground lease, Pete, is when a landowner leases unimproved land to a tenant who agrees to erect a building on it. That's typically called a ground lease, and ground leases usually are long-term. They usually last in duration between 50 to 99 years. So it's a very simple concept, but there are two keys to it. The one key is the land has to be unimproved, and the second key is that the tenant agrees to erect a building on the unimproved land. That is a ground lease. Good question. I appreciate it. Ladies and gentlemen, that's a wrap. As always, thanks for watching.